Welcome to Smart Trading Action Alert. I'm Laura Cadden. After a year and a half of declining home sales, rising defaults, and stagnating prices, it would seem that the housing bubble has burst for good. April numbers may show that sales of new single-family homes are up 16.2% over March, but overall, sales were down 10.6% over April of 2006. Home building stocks and real estate investment trusts now trade at fractions of the prices they commanded only 18 months ago. Has the housing market bottomed out? Or is the full impact still to be felt in the months and perhaps years ahead? Most importantly, where can smart traders turn for a profit? I've invited Ian Cooper, Chief Strategist of Death Cross Trader, to give us his viewpoint on the housing market and highlight an easy-to-execute trading strategy. So Ian, where do you think the housing market is heading? I mean, is the worst over?
Absolutely not. Anybody that tells you that the housing bottom is in, you can have my permission to laugh in their face. Supply continues to outweigh demand. Mortgage rates are continuing to spike. Still, the housing bulls would have you believe that there is a bottom in place. Forbes.com, for example, headlined an article recently saying, we're nearing a housing bottom. Treasury Secretary Paulson had us believe that the near-term correction that we've been seeing is almost over. It's just not going to happen. Mortgage rates are spiking. Just yesterday, we saw that housing starts fell 2.1% after a readjusted 1+ percent in for April. Delinquencies for Q1 '07 just spiked to 15.75%. From Q4 2006 is 14.4%. Yet the housing bulls would still have us believe that a bottom is in place. This is not the case. Again, you have my permission to laugh in their face if you want. That's fine. Home builder confidence levels just came in at 28 from 30. Anything under 50, from my understanding, is an indication of very poor market conditions from the viewpoint of a home builder. Home prices are expected to fall 1.3% year over year. Housing starts are expected to fall. We're really not in a position to call a housing bottom at this point.
And you think the mortgage rates will continue to rise?
Absolutely. We could easily see 7.5%. This time last year we were at 5.66%. Last week we were at 6.5%. We now sit at 6.74%. That's continuing to spike. For me to sit here and call 7.5%, people may laugh at that, but that's the honest truth. 7.5% really isn't out of the question.
Well, if you've bought a house over the past 10 years or say, though, 7% really doesn't seem all that bad.
Right.
I mean, wouldn't one expect that if the builders and the lenders who are in trouble right now, wouldn't they perhaps offer reduced rate incentives, like the car industry would?
Right. Well, that's exactly what they're doing. Still, they're running into a problem where they have more glut than they have demand. Look at it this way. A 30-year mortgage today at 6.74%. If you take out a $300,000 mortgage, you're paying $400 extra a month at 6.74 than you would 2 months ago when that same mortgage rate was at 5.66%. Mm-hmm. So you're seeing a lot of people that are sitting on the fence. They don't want to buy a new home. Either they have a new home, they don't want to buy a new home just yet because they don't want to pay that extra $400 a month. As for the incentivized programs, you can look at Pulte Homes. Pulte Homes is running an offer of what's called the Perfect 10. In California and Nevada, for example, I think they're offering up to a 10% discount on homes. I've seen one home builder offer $5,000 for closing costs, $5,000 in free upgrades. They'll pay 6 months of your principal and of your principal balance. I've even seen one offer boating club membership, which is the most ridiculous thing I've ever seen. But it just goes to show that there's too much glut on the market. They need to get rid of this glut.
Well, after years of annual 20+% gains, these drops in home prices and sales declines don't seem terribly dramatic to existing homeowners. What kind of catalyst are you seeing for a substantial downturn?
Well, you also have to take into consideration that more than 2 million adjustable rate mortgages are going to reset for the remainder of this year and next, which could force many people into further delinquencies, further foreclosure rates. You're going to see higher delinquency rates than the 15.75% that we just saw for Q1 '07. You'll see that year over year come next year, maybe farther out this year. What's going to happen is that's going to force further glut onto the market, and you're going to see home builders lowering prices even further. You're going to see even more incentivized programs. Just yesterday I saw that housing starts fell 2.1% to 1.474 million from a readjusted 1% rise for April of 1.5 million. We're not out of the woods yet. Housing is still a big, bad issue as of now.
So what related sectors to housing can traders look for profit opportunities?
Well, honestly, right now I would stay out of the housing sector. I would look to buy Toll Brothers January 40 puts long term. I believe Toll Brothers and some of the other glamorized, high-end luxury home builders are going to really struggle considering the higher interest rates and their tighter lending standards. I'd stay away from housing retailers such as maybe Lowe's. In the sector, I do like Home Depot, though. They just got rid of their HD supply unit for a really, nice piece of change. I think they just announced a stock buyback, which, if true, would be nice. They just got rid of their last CEO, so things are a turnaround story for there. I'd stay away from, retailers. Best Buy had a horrible quarter. Pier 1 Imports just warned. You're running the gamut with very poor earnings from a lot of retailers. For the longest time, people would say we're not entering a recessionary period. There's no spillover from subprime housing. But, the fact is that there is. It's going to impact consumer spending. We could run into a recession by year end. In that case, I would also stay away from, residential REITs, commercial REITs. I would also stay away from housing retailers, as I said. I'd stay away from luxury home builders. But I'd also look at retailers such as, Dollar Tree, 99 cents only. Their business model is to offer discount goods at discount prices. So I would look at them if we enter a recessionary period, because people are going to want to save money and they're going to want products at cheaper costs. So I would look at Dollar Tree, 99 cents only. Companies like that offer a business model of discount prices.
Oh, very interesting. Thank you for your perspective.
Thank you for having me.
To learn more about Ian Cooper's trading information service, Death Cross Trader, go to www.deathcrosstrader.com. Please tune in next week for another profitable opportunity on TFN's Smart Trading Action Alert. For TaipanFinancialNews.com, I'm Laura Catton.